Let's get to Howard Silverblatt because he looks a lot at this. He's a senior index analyst at Standard & Poor's. And Howard, I haven't seen you in a while either, but I know you like to talk about dividends. And as John was just talking about, it could take 5 years to get us back to the levels that we saw before. Is that about your estimate?
Yeah, we believe about 2013 you'll be getting comparable numbers to what you were getting in 2008, and it's going to take you to 2015 or 16 to make up the money because you're not getting as much now. Remember, unlike a stock price, a dividend people are living off of, so that difference, that $53 billion, the retiree or an institution has to get from somewhere. So they're out that money. It's going to take a long time to come back. And although companies do have enormous amounts of cash, record amounts, they're going to be slow to increasing. So far this year, we're seeing about an average of 7% increase on the dividend increases. 2 years ago, it was 17%. So it's going to be slow going.
And Howard, put this in context for an investor who historically has held dividends. What kind of return can you expect when you're getting your full dividend payment versus when you're not?
Well, it's a lot lower now when you look at it, 2 to 3%, especially if you're looking for issues that have decent coverage of 1.5 or 2 times. I mean, if you want to go for more risk, less coverage, you can get a 6%. But the yields are significantly lower than they have been historically, but they are still comparable. The average paying yield in the 500 is a little bit more than the 5 years. It's about 2.4% compared to about 2.2. So they're comparable, but they're not what you're used to. And that's a lot less dollars coming in each month or each quarter.
Now, Howard, it's Adam here. What strikes me is that while they're down, you're still better off with stock dividends than in bonds because bonds are even lower. So if you're going to focus on just stocks, where do you go at this point?
Well, consumer staples, as you said, it has been the most stable one in the market. 33 of their 34 have actually increased. They've picked up the slack. Financials used to be 30% of the dividends. Now they're down to 9%. Consumer staples is up to over 17.4% of that. And their stock price reflects it to some degree. They are the only sector that is actually above on a total return basis from the October 07 highs. So their stock price did not go down as much. It did not go up as much. They were a lot more stable. Their earnings also, these dividends portray stable earnings. And more importantly today, what investors really need to look at is cash flow. Positive cash flow on there. But again, the yields are not where you think they are.
Okay, Howard, we'll have to leave it there, but thanks again, and good to see you, Howard Silverblatt at S&P.